This is David Crowell of Mortgage Network, and this is Money Matters. And we're back for the second half of the show. And I am in the midst of giving you an update and a survey and an overview of the condition of the mortgage market at this point in the national economic recovery. So we're at step two, which is the mid-market, homes at $300,000, $350,000, $400,000 for move-up homeowners and incoming retirees. That market is also fascinating. Fannie Mae and Freddie Mac both participate in that market. Rural housing drops out because it really has very strict conditions on how much money you can make and how much money you can have in the bank. In other words, it really is a first-time home buyer program. So it drops out. FHA is still in there strong, and Fannie Mae and Freddie Mac are in there strong. So what does that mean? Well, that means that the typical transaction that we see in the $300, $350 range is FHA, which would be 3.5% down, and that $300,000 house is going to therefore have a $10,000 down payment. It's going to have approximately a $1,200 mortgage payment, $1,250, $1,275, somewhere in there, with taxes and insurance and everything loaded in, another $300 perhaps. So that's going to be approximately $1,400 or $1,500. It's pretty remarkable that housing can be as cheap as that. The Fannie Mae solution of a conventional mortgage in that situation has usually 20% down. People who are retiring are going to put 20% or 30% or 40% down usually, because they're bringing money with them from a home up north that's sold, or they're straddling and buying the home down here in anticipation of retiring sometime in the next 2 or 3 years. Now, I'm going to stop there for a moment and say those transactions are very doable and very highly feasible at the moment. You should not be frightened of the straddle. Housing market nationwide is fluid enough and active enough so that reaching out to Beaufort County for your pre-retirement home, buying it, and then selling, retiring a year or two later and selling the home up north, very, very feasible at this point. The cost is modest enough, and the market is fluid enough, so the likelihood of you getting stuck with two houses for an interminable amount of time and all the fear that goes with that is very small. So, high 3% range, $1,400, $1,500 for a $300,000 home, or Fannie Mae equivalent $1,300 or $1,350 for the same home. Pretty remarkable. Then we move to the next leg of the journey, and to the $400,000 to $600,000 range. This is pure Fannie Mae, because FHA drops out now. The maximum FHA loan in this part of the world, in Beaufort County, the maximum FHA loan is $351,000. So that's it. So now it's really that 400 to 600 range is really Fannie Mae territory. What we do is write a $417,000 Fannie Mae loan. That's the maximum. We typically see 5% down, 10% down, 15% down, 20% down. That's the typical deal. What we also see is combinations of the $417,000 Fannie Mae loan, which is the maximum loan for Fannie Mae, coupled with an equity line of credit so that a borrower can conserve cash. If you're buying a $600,000 home, it's often wise to do the Fannie Mae 417 and perhaps a $100,000 line of credit with it. Then when the home up north sells, pay off the line of credit, keep the mortgage, and continue into the distance. The flexibility that we now have is enormous compared to even 2 or 3 years ago. Lots and lots of options. And it's very rare that for an incoming pre-retiree or retiree or for a move-up home buyer, it's very rare that we can't do the deal and find a number of options that work. Next step up, 600 to $1 million, 600 to $1.2 million. That's the heart of the old Hilton Head market, of the nicer homes in Sea Pines and Palmetto Dunes and Indigo Run. That's the market that emerged in Colleton, Belfair, and Berkeley during the boom. Those houses, 600 to $1.2 million, simply were such a problem to get financed coming out of the recession. Now there is no problem whatsoever. In fact, and this is very interesting, they're called jumbo mortgages. Basically, that's any mortgage greater than $417,000. Jumbo mortgages have been in an inverse interest rate relationship to conventional mortgages for several months now. In other words, jumbo mortgages are cheaper. We haven't seen that for 20 years. We've seen it at various times during the last year when the jumbo loan is actually cheaper than the conventional loan. So you can have a full range of jumbo product, up to 80% loan to value, 80% of the purchase price for jumbo loans for your primary residence here or your secondary residence here. It's very, very exciting development. And the prices of all those mortgages are in the high to low 3% range. Good stuff. Final pop loans for homes in the $1.2 million to $3, $4, $5 million range. We are seeing more and more mortgages written at the $1.5 million or $2 million or $2.5 million range. Not a problem, but your down payment increases. If you want a $2 million mortgage, it's very likely that we're going to ask you to put 40% down. So, in other words, you're going to have to go. If you want to buy a $3 million house, you're probably going to have to put $1 million down, or $1.2 million or $1.3 million to get to 40%, and we'll lend the rest. So, very not restrictive at all. The overlays are where the game gets interesting. The overlays are credit, all sprinkled throughout this. The price of the money and how aggressive the mortgage is dependent somewhat on your credit. Also, the overlay, the self-employed borrower is going to get a great deal more scrutiny and go through a great deal more paperwork than the W-2 employee, because we really want to make sure nowadays that the self-employed borrower can afford what he wants to do and has the track record to back it up. But at the end of the day, our approvals are higher today than they were at the height of the boom. So when all is said and done, the paperwork is more intense. The process of getting the mortgage is more involved and more detailed than at any time since I've been in the business. It's sometimes feels a little exhausting, but when you look 20/20 hindsight at applications and the ratio of applications to approvals, to deals concluded, to mortgages actually written, we're getting a higher rate of approvals and a higher rate of success than we were even at the height of the boom. So looks can be deceiving. It's harder work, but the success rate is incredible. So next time you're in a conversation with somebody who's hoping to do this, that, or the other, but is fearful of the financing side of it, tell them to come and talk. Talk is cheap, talk is free, and I think you'll be surprised. Well, this is Money Matters for this week, and I hope you've enjoyed it. And Emily will be back next week, and we'll see you then. Bye-bye.